Currency Pro, Part 6, How Governments Manage Currency Exposure. In this video, I'll cover how governments manage the value of their currency. There are basically 3 levels of this. First, there are countries that do not attempt to manipulate their currencies in any way, like the United States of America. The dollar, euro, and pound are all good examples of countries that have what are known as free-floating currencies. Free-floating currencies just move based on supply and demand in the markets. Government actions do impact them, like raising and lowering interest rates, but they're not doing those things to manipulate the value of the currency. The second level is when countries, quote, manage their currencies, but don't peg them. This can manifest itself in a few different ways. Remember how I said the yen had fallen a lot in 2022 due to rising interest rate differentials between US government bonds and Japanese government bonds? Well, that was in spite of the fact that Japan spent over $62 billion buying yen to prop up its value. Otherwise, it would have been weakened even more. The Chinese government also started doing this recently after the yuan hit a 16-year low against the dollar. China is also a good example of how countries can manage their currency on a more regular basis. Japan only does this at extremes. China does it daily if needed. Their currency isn't quite pegged, which we'll cover in a moment, but it's what I would call quasi-pegged to a basket of currencies that's mainly made up of the US dollar. They allow it to fluctuate up to 2% per day, but they intervene if needed to keep it within that band. This is why it's so funny to me when people think China wants to weaken the dollar. They actually want to keep the yuan stable against the dollar. Well, technically the basket of currencies, but it's mostly the dollar. So what that means is that if the dollar is weakening a lot, China will actually buy a lot of treasury bonds to prop it up. That's how much they don't want the dollar to weaken. So why would they do that? Well, the United States buys a lot of stuff from China. We can also buy things from Mexico, Vietnam, or wherever. So if their currency gets too strong relative to the dollar, their exports will be less competitive. And they don't want that because they're an export-driven economy and the US is their largest customer. The third level of currency control is a peg. That's when a country keeps their currency exactly in line with another one. Currency pegs have upsides and downsides, but the goal of one is to reduce currency fluctuations. That can help the government and the broader economy. From a government perspective, a peg can help by reducing the volatility of your cash flows. A lot of big oil producers like Saudi Arabia, the UAE, and Iraq peg their currencies to the dollar because almost all their exports are oil, which is mostly sold in dollars. However, a lot of their expenses for things at home, like building roads and paying workers, are in their home currency. If their home currency strengthened a lot against the dollar, their revenues would essentially decline since they're in dollars, and they might not be able to pay their workers. If their currency weakened a lot, they might have a hard time paying for imports, which are not all in dollars. A peg can also help the broader economy because by linking your currency with a stronger, more stable one, it will reduce its volatility and make the country more appealing to foreign investors. There are 2 main downsides of a peg. First, the government has to hold a lot of foreign reserves, aka foreign currencies, in order to maintain the currency peg. For example, if the Saudi Arabian rial weakens against the dollar, which it's pegged to, they have to buy rials and sell dollars to prop the rial back up. If the rial strengthened against the dollar, they have to buy dollars and sell rials to bring their currency back down. Those currency reserves could be used to do more productive things if they didn't have to be there to manage the currency and maintain the peg. By the way governments buy one currency and sell another to maintain their peg is often with currency swaps, which we discussed earlier. The second disadvantage of a peg is that you give up the ability to use monetary policy to benefit your country. This is also the downside of a common currency like the euro and the gold standard, which I'll cover in the next video. When you peg your currency, you basically import the monetary policy of the country it's pegged to, whether it's good for your country or not. Let's say the US has high inflation. They'll want to raise interest rates to bring it down, like we saw in 2022. But raising interest rates increases the value of the dollar, all else equal. If a country pegs their currency to the dollar, they also have to take steps to strengthen their currency to keep it in line. One way would be to buy a bunch of their own currency on the open market to strengthen it, but they only have so many reserves. In a way, they almost have to raise interest rates to strengthen their currency along with the dollar. But what if their economy is going through a recession and they should actually be lowering rates to boost growth? Doesn't matter. They're essentially forced to follow the US to maintain the peg. So currency pegs can help stabilize a really unstable currency, but they can also be a double-edged sword. And as a country becomes wealthier and more developed, it makes less and less sense for them to peg their currency. In my next video, which will be part 7, I'll dive into why the gold standard failed and why we're never going back to it. And by the way, this is a 10-part course that's gonna roll out over 5 weeks on YouTube. But if you want access to all 10 parts right now without clicking around YouTube or watching ads, check out the link below. Thanks for watching.